Welcome back to Algobot, the channel where we take apart automated trading systems and study how they actually think. I'm your host, Algobot, and today we're examining an expert advisor for MetaTrader 5 called Exhaustion Gap Reversal. This is a pure price action strategy with no indicators at all, built around a single idea borrowed from market structure, the fair value gap. By the end of this video, you'll understand what an exhaustion gap is, why this strategy reads one as a sign of an overextended market, and how it looks to trade the snapback that often follows. Everything here is educational only, never financial advice, so let's dig in. Let's start with the big picture. Exhaustion gap reversal is a counter-trend system that trades one very specific price action pattern, the fair value gap. A fair value gap is a three-candle imbalance. When one candle in the middle moves so quickly that its neighbors don't overlap, it leaves a small void on the chart, a zone that price effectively skipped over. Many gap strategies treat that void as support or resistance and trade in the direction of the move. This strategy does the opposite. It looks for gaps that appear at the very end of a run when the market is stretched thin. The key filter is exhaustion. The strategy only pays attention when the impulsive candle that opens the gap also drives price to a brand new swing extreme, a fresh high in an up move, or a fresh low in a down move. The reasoning, framed educationally, is that a thrust to a new extreme late in a move is often a grab for liquidity rather than the start of a clean new leg. It can be the last push of an exhausted side. So instead of following that push, the strategy prepares to fade it and trade against it. It was built with foreign exchange majors and gold in mind, on time frames from 15 minutes up to 1 hour, although the code itself is locked to no fixed time frame and simply runs on whatever the chart provides. There are no indicators anywhere. The only average it computes is a plain mean candle range, used to make sure a gap is meaningfully large relative to recent volatility. Who is this style suited for in an educational sense? Traders who are curious about market structure and order flow concepts, and who want to study mean reversion behavior rather than trend following. As always, this is information only, not financial advice, and trading carries a real risk of loss. Now let's walk through the exact logic, step by step. The strategy works entirely on closed candles. Every time a new bar closes, it takes the three most recent candles and labels them. Candle 1 is the oldest, Candle 2 is the impulse in the middle, and Candle 3 is the newest. First, it measures context. It looks back over a window of earlier candles, 20 by default, and calculates two things: the average candle range and the highest high and lowest low of that window. The average range sets a minimum gap size, so tiny, insignificant gaps are filtered out. The window high and low define what counts as a fresh extreme. Then it checks for a bull exhaustion gap. The condition is that Candle 1's high sits below Candle 3's low, leaving an upward void, that the impulse candle closed higher than it opened, and that the gap is at least as tall as the minimum. On top of that, the highest point of the three candles must exceed the prior window high, a brand new swing high. When all of that lines up, the strategy arms a sell setup. It records the gap's two edges and remembers the exhaustion high as a protective level. The mirror image, Candle 1's low above Candle 3's high, a down-closing impulse, and a fresh swing low, arms a buy setup. Arming is not entering. Confirmation always needs a later candle. For an armed sell, the strategy waits for a future candle to close bearish and to travel back down into the gap, past a tunable FillFraction, half the gap by default. When a candle closes back inside that zone, the sell is placed. For an armed buy, it waits for a bullish candle to close back up into the gap. Risk control is built in. On a sell, the stop loss sits just above the exhaustion high, with a small buffer scaled to the gap height. The take profit is a fixed multiple of that risk, 2 times by default, so the reward-to-risk ratio is set in advance. A buy is the mirror. Stop just below the exhaustion low. Target a fixed multiple above. 2 safeguards keep things tidy. If price closes beyond the exhaustion extreme, a genuine new high or low, the setup is canceled because the thrust proved real rather than exhausted. And if confirmation doesn't arrive within a set number of bars, the setup simply expires. Only one position is held at a time. Here's the heart of the strategy as it appears in MetaEditor. At the top are the input parameters you can adjust in the EA's settings. Look back sets how many candles form the reference window for both the swing extremes and the average range. A larger value demands a more significant move to count as fresh. MinGapFactor is the minimum gap size expressed as a fraction of that average range. So raise it, and only larger imbalances qualify. FillFraction controls how deeply a candle must close back into the gap before the strategy acts. A higher value waits for a fuller retracement. Confirm expiry is how many bars an armed setup stays valid before it is discarded. RewardRisk is the reward-to-risk multiple for the target. Stop buffer PCT adds a cushion beyond the extreme for the stop, and lots is the fixed trade size. Below the inputs is the detection logic. The code reads the highs and lows of the three newest candles, then tests the bull exhaustion condition. Candle 1's high below candle 3's low, an up-closing middle candle, and a gap at least as large as the minimum. If the highest of the three candles also clears the window high, it marks a fresh high and arms the sell, storing the gap edges, the protective high, and the bar count at the moment it armed. The final block is the snapback confirmation. It computes the fill level inside the gap, then checks whether the last candle closed at or below that level, closed bearish, and that no position is already open. When those are all true, it calls inner short, which places the sell with its stop above the exhaustion high and its fixed reward-to-risk target. The buy side mirrors every line of this in the opposite direction. Let's watch the strategy on an illustrative chart. Reading left to right, price is drifting lower. Then a sharp down candle pushes through and prints a brand new low. That's the impulse. Notice the small void it leaves behind. Candle 1's low sits above candle 3's high, forming a fair value gap, shaded green here as a potential buy zone. Because that thrust reached a fresh swing low, the strategy reads it as exhaustion and arms a buy. It does not enter yet. A couple of candles later, a bullish candle closes back up inside the gap, past the fill level. That's the confirmation, and the buy entry appears. The stop rests just below the exhaustion low, marked by the lower dashed line. From there, price recovers and climbs steadily until it reaches the take profit, a fixed multiple of the risk above the entry. Now watch the second half of the chart. Price keeps rising, and another impulse candle drives upward into a brand new high, leaving a fresh gap above, shaded red, as a potential sell zone. Candle 1's high is below candle 3's low, the impulse closed higher, and the swing is fresh, so the strategy arms a sell. Again it waits. A later candle then closes bearish, snapping back down into that gap past the FillFraction, and the sell entry fires. The stop sits just above the exhaustion high, on the upper dashed line, and the target is a fixed multiple below. Price rolls over and slides down to take profit. So in both cases the pattern is identical. An overextended thrust to a new extreme, a gap left behind, and a confirmed close back into that gap before entering against the move. This is a simplified illustration for learning only. Real markets are far noisier, and not every setup behaves this cleanly. So that's the Exhaustion Gap Reversal Expert Advisor. We covered what a fair value gap is, why this strategy treats a gap at a fresh extreme as a sign of exhaustion, how it waits for a confirmed snapback before entering against the thrust, and how it manages risk with stops beyond the extreme and fixed reward-to-risk targets. Remember, everything in this video is educational content only, and not financial advice, a recommendation, or a solicitation to trade. Automated strategies can and do experience losing trades, and no approach works in every market. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like us to analyze next, and subscribe for more MetaTrader 5 strategy studies. You can find more over at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.